Trading. Welcome, everyone. Today, we are here to help you figure out which chart patterns are best for your trading style and goals. Before we dive in, let me ask you this. Have you ever looked at a trading chart and felt like it was a puzzle waiting to be solved? You are not alone. Many traders feel that way, but the key to success is understanding which pieces fit your own style and strategy. By the time we are done, you will have a clear idea of which patterns align with your approach, whether you are looking for short-term gains, long-term investments, or something in between. So, stick around, because this guide might be exactly what you have been looking for. Chart patterns are key to spotting opportunities in the market, but they do not work the same way for everyone. That is why it is so important to learn about which ones could work best for you. There are basic, intermediate, advanced, and even exotic chart patterns to choose from, each serving a different purpose depending on your trading level and strategy. Let us start with the basics. Basic chart patterns are ideal for beginners because they are easier to identify and understand. These include double tops, double bottoms, and simple flag patterns. Double tops occur when the price reaches a high point twice and is unable to break above that level, signaling that the uptrend is weakening and that a reversal may be imminent. Double bottoms are the opposite, where the price hits a low level twice and is unable to break lower, indicating that the downtrend might be ending and an upward move could be starting. These reversal patterns are useful for recognizing potential trend changes and can be a great tool for beginner traders who want clear signals. Flags, on the other hand, are continuation patterns. They occur after a strong price move, either up or down, and are characterized by a small, rectangular consolidation phase. This phase looks like a flag attached to a pole and suggests that, after this brief pause, the price is likely to continue moving in the original direction. Bull flags indicate a continuation of an uptrend, while bear flags signal the continuation of a downtrend. These patterns are particularly helpful for traders looking to enter a trade after a strong move while minimizing risk during the consolidation. Other basic patterns to be aware of are pennants and rectangles. Pennants are similar to flags but have converging trend lines, indicating that the price is tightening before continuing the original trend. Rectangles form when the price moves sideways between two horizontal levels of support and resistance, and can also be a continuation pattern when the price eventually breaks out of the range. These patterns are straightforward, easy to spot, and provide a solid foundation for those just starting out in trading. Once you feel comfortable with the basics, you can move on to intermediate patterns. Intermediate patterns include triangles, wedges, and the cup and handle. Triangles come in three types: ascending, descending, and symmetrical. Ascending triangles form when there is a horizontal resistance line with rising lows. This pattern suggests that buyers are gaining strength, and a breakout to the upside is likely. Descending triangles are the opposite, featuring a horizontal support line with declining highs, signaling increased selling pressure and a potential breakout to the downside. Symmetrical triangles have converging trend lines that indicate indecision in the market, but once the breakout occurs, it often leads to a sharp move in the direction of the breakout. Triangles are very popular among traders looking for breakout opportunities, but it is important to wait for a confirmed breakout before entering a trade. Wedges can either rise or fall, and they often indicate a trend losing momentum and getting ready to reverse. A rising wedge occurs when the price makes higher highs and higher lows, but the trend lines are converging. This pattern typically signals that an uptrend is losing steam and a bearish reversal may be imminent. Conversely, a falling wedge is characterized by lower highs and lower lows, with the trend lanes also converging. This pattern usually suggests that a downtrend is weakening and may be ready for a bullish reversal. Wedges can take some time to form, and it is crucial to watch for a breakout of the trend lines, ideally accompanied by increased volume to confirm the reversal. The cup and handle pattern is a bullish continuation pattern that suggests a significant upward move after a period of consolidation. The cup part of the pattern resembles a rounded U shape, indicating a gradual shift from selling to buying. After the cup forms, a small consolidation phase known as the handle takes place, typically showing a slight pullback. Once the price breaks out of the handle, it often leads to a strong upward move. The cup and handle pattern is highly valued by traders who are looking for longer-term continuation signals, as it usually represents a period of accumulation before a major price movement. Proper identification of this pattern requires patience, as the formation can take a considerable amount of time. These intermediate patterns require a deeper understanding of market dynamics and often involve more practice to identify correctly. It is important to take your time studying them, practice spotting them on historical charts, and use simulated trading environments to gain confidence before applying them in live trading. Mastery of these patterns can significantly enhance your ability to predict market behavior and make informed trading decisions. For those with more experience, advanced patterns provide additional insights into market behavior. Advanced patterns include the head and shoulders, inverse head and shoulders, and various harmonic patterns. The head and shoulders pattern is known for indicating a reversal from an uptrend. It forms with three peaks. The middle peak, the head, is higher than the two shoulders on either side. This pattern shows that buyers are losing strength, and it often signals that a downtrend is about to begin. Traders watch for a break below the neckline, a support level that connects the lows between the shoulders, which confirms the reversal. The inverse head and shoulders is essentially the opposite, signaling a reversal from a downtrend. This pattern has three troughs, with the middle trough, the head, being the lowest, and once the price breaks above the neckline, it often indicates the start of an uptrend. Both head and shoulders and inverse head and shoulders are considered reliable reversal patterns, and they are often used by traders looking for major shifts in the market. Harmonic patterns such as the Gartley, bat, or butterfly are more complex and are based on specific Fibonacci ratios. These patterns require precise measurements to be identified correctly, as they predict potential reversals or continuations with high precision. The Gartley pattern, for example, indicates that a correction is coming to an end, and it often signals a strong move in the opposite direction. The bat pattern is similar to the Gartley, but has different Fibonacci measurements, making it even more specific in identifying reversal zones. The butterfly pattern usually signals that a trend is extending, and it predicts a reversal at an extreme high or low point. Harmonic patterns can be incredibly rewarding, but they demand a strong understanding of Fibonacci ratios and the ability to accurately measure retracements and extensions. Another advanced pattern is the Elliott wave, which is used to describe the natural rhythm of crowd psychology in the market. It suggests that market movements occur in repetitive cycles, typically consisting of 5-wave impulsive moves followed by 3-wave corrective phases. Identifying these waves correctly can provide significant insight into the market's overall trend and potential turning points. Elliott wave analysis is advanced because it requires a deep understanding of wave structures, but it can be very powerful when used effectively. These advanced patterns require a strong understanding of market psychology, patience, and the ability to recognize complex formations. Traders using advanced patterns need to practice extensively to gain the skill required to accurately identify them in real time, and often use additional confirmation tools such as volume analysis or momentum indicators to increase the likelihood of success. Finally, there are exotic patterns. These patterns are less common, but can be highly effective when used correctly. Exotic patterns include the butterfly, crab, dragon, three drives, and even lesser-known formations like the shark and cipher patterns. The butterfly pattern is a type of harmonic pattern that occurs at the end of an extended move and is used to predict reversals. It requires precise identification of Fibonacci levels to pinpoint potential reversal zones, making it highly effective but also challenging to use. The crab pattern, another harmonic pattern, is known for its deep retracement levels and tends to appear when the market reaches an extreme high or low. It provides accurate entry points but requires a thorough understanding of Fibonacci extensions. The dragon pattern is a bit different from traditional harmonic setups. It resembles a dragon's back with price movements forming humps and a tail. This pattern suggests a sharp reversal after a pullback and often indicates the beginning of a strong directional move. The three drives pattern is a reversal setup consisting of three successive pushes to new highs or lows, each followed by a corrective pullback. This pattern often signals exhaustion and a reversal in trend direction, and it can be highly effective if identified correctly. Shark and cipher patterns are also part of the harmonic family, but they differ in terms of structure and Fibonacci ratios. The shark pattern is an advanced formation that signals potential market exhaustion, while the cipher pattern often appears during corrective phases, providing excellent opportunities to enter in the direction of the main trend. These exotic patterns require precise knowledge of Fibonacci levels, meticulous chart analysis skills, and an understanding of market psychology. Because of their complexity, they are best left to traders who are comfortable with advanced technical analysis and have plenty of experience in recognizing more intricate formations. However, it is important to remember that knowing all these patterns does not guarantee success as a trader. Trading success depends on discipline, risk management, and consistent application of your strategies, not just pattern recognition. When used effectively, these patterns can be incredibly rewarding, as they offer a unique perspective on market behavior and can lead to well-timed entries and exits. Every trader is different, and each trader might resonate with certain patterns based on their own preferences and style. Some traders may find that simple patterns like double tops work best for them, while others may prefer the complexity of harmonic patterns. The best approach is to explore different patterns, practice identifying them, and figure out which ones feel the most natural to you. By doing this, you can tailor your trading strategy to fit your strengths and tendencies, ultimately improving your trading performance. So, let us jump right in and discover which chart patterns match your trading style. To get started, let us answer a simple question. What exactly are chart patterns? In short, chart patterns are shapes or formations that show up when prices move over time on a trading chart. Traders use these patterns to predict where prices might go next and to find trading opportunities. Different patterns serve different purposes, and the key is figuring out which ones align with your own strategy. Are you someone who loves quick action, or do you prefer to go for the long haul? Let us find out which patterns fit your style best. If you are a short-term trader, then you need patterns that give you clear and fast entry and exit points. One of the best patterns for this is called the bull flag. This forms after a strong move up, then the price moves sideways for a bit. After this pause, it often moves up again. If you enjoy fast trading and love catching trends as they happen, this pattern can be perfect for spotting quick breakouts. There is also the bear flag, which is the opposite of the bull flag. It forms after a sharp drop, then the price pauses before continuing to fall. This one is great if you are looking to short stocks or take advantage of market drops. You can also use ascending and descending triangles if you are a short-term trader. These triangles signal a breakout, either to the upside with the ascending triangle or to the downside with the descending one. If you like to trade breakouts right when they happen, these triangles are very useful. Just remember, you will need to be comfortable with setting tight stop losses because they can be quite fast. Now let us shift gears and talk about chart patterns for long-term investors. Long-term investors are looking for patterns that signal a price move that will last longer. One of the most popular long-term patterns is called the cup and handle. It starts with a U shape, which is the cup, and then there is a small pullback which forms the handle. After this, the price often goes up a lot. This makes it a great pattern for identifying stocks that are getting ready for a big move upward. Another great long-term pattern is the head and shoulders pattern, along with its inverse. The head and shoulders pattern signals the top of a market, which means a reversal from an uptrend. On the other hand, the inverse head and shoulders signals the bottom of a downtrend and often leads to a price rise. Long-term investors love these patterns because they help spot big shifts, which gives you the chance to catch longer-term movements. Now, let us focus on those who love trading breakouts. If you are a breakout trader, you are looking for explosive moves after the price has been stuck in a tight range for a while. One of the best patterns for this is the symmetrical triangle. This pattern shows that the market is consolidating, meaning it is stuck between two converging lines. When the breakout happens, it often leads to a very sharp and fast price move. Another breakout-friendly pattern is the rectangle pattern. This pattern forms when the price bounces between two levels, support and resistance. Eventually, the price breaks out of this range, either up or down, and the resulting move can be very strong. If you like waiting for clear setups before making a move, this pattern could be perfect for you. For those of you who like to follow trends until they end, let us talk about trend following patterns. A wedge, either rising or falling, is great for this. A rising wedge often means the trend is losing momentum and may break down. A falling wedge usually signals a breakout to the upside. These patterns are great if you want early warning that a trend might be about to end or continue. Continuation patterns like flags and pennants are also very useful for trend followers. They form after a big move up or down, followed by a pause. These patterns suggest that the trend will continue after this short break, giving you a signal to jump back in and ride the trend further. Now, if you are more on the cautious side and prefer to minimize risk, we have patterns for you as well. Double tops and double bottoms are very reliable for risk-averse traders. A double top signals a reversal from an uptrend, while a double bottom signals a reversal from a downtrend. These patterns provide clear areas of support and resistance, which makes it easier to set safer stop losses and know exactly where you are getting in and out. For even stronger confirmation, there are also triple tops and triple bottoms. They work similarly to double tops and bottoms, but with 3 peaks or valleys instead of 2. These are considered more reliable, and they are great if you want extra confirmation before making a move. Let us move on to those of you who like catching market reversals. Reversal traders focus on spotting when a trend is about to change direction. The rounding bottom and rounding top patterns are fantastic for this. The rounding bottom signals a slow and steady reversal from a downtrend, while the rounding top signals a slow reversal from an uptrend. These patterns take time to form, but they can offer some of the best opportunities to catch the start of a new trend. Another set of patterns for reversal traders are descending and ascending channels. A descending channel shows a downward trend that may be ready to reverse if it breaks to the upside. The ascending channel works the opposite way, showing an uptrend that might reverse to the downside. Channels are fantastic for spotting when the market might be ready to change direction, giving you a chance to trade the reversal. So, how do you choose the right chart pattern for yourself? First, you need to think about your trading style. Are you a day trader looking for quick moves, or are you a long-term investor focused on steady growth? Every trader is different, and there are a myriad of chart patterns to choose from. Each trader might resonate with certain patterns based on their own preferences and style. Short-term traders often like flag and triangle patterns, while long-term investors may prefer patterns like the cup and handle. It is important to remember that what works well for one trader might not work as well for another. The best approach is to explore different patterns, experiment with them, and find which ones you feel the most comfortable with. By doing so, you will be able to tailor your trading strategy to your own strengths and tendencies. Next, consider your risk tolerance. If you are someone who is risk-averse, it makes sense to focus on patterns that have clear entry and exit points like double tops or rectangles. If you are more aggressive, breakout patterns like wedges or triangles might be better suited for you. And remember, whatever pattern you choose, it is always best to practice using it in a simulated environment first. Testing these patterns in a demo account can help you see how they work in real time without risking real money. Now, let us go over some common mistakes that people make when using chart patterns. One of the biggest mistakes is ignoring confirmation. It is risky to act on a pattern without waiting for confirmation. Always wait for the breakout or reversal to be confirmed, ideally with volume or another technical indicator. Another common mistake is overcomplicating things. This can mean trying to identify patterns that are not actually present or adding too many indicators that end up clouding the chart. Sometimes traders are so eager to find a setup that they convince themselves they see a pattern that is not really there, leading to poor decisions. It is important to stick to clean and clear formations that naturally fit the price action. Adding unnecessary lines, indicators, or trying to force a specific outcome onto the chart can make things more confusing and lead to mistakes. Instead, focus on clear, well-defined patterns that align with your strategy and avoid overthinking it. Remember, simplicity often leads to better decisions and more effective trading. And finally, failing to set stop losses is a mistake that even experienced traders make. Even the best patterns can fail, so always make sure to set stop losses to protect your capital in case things do not go as expected. To wrap this all up, finding the best chart pattern for yourself comes down to your trading style and how much risk you are willing to take. Whether you are looking for quick trades with flag patterns or longer-term moves with head and shoulders, there is a pattern out there that will fit your approach. However, trading is not without its challenges. Traders often face several common issues that can hinder success. One major issue is dealing with emotional decision-making. It is easy to get swept up in the excitement of a breakout or the fear of a sudden drop. Emotional trading can lead to overtrading or holding positions for too long. A solution to this is to have a clear trading plan and stick to it regardless of market noise. Setting defined entry and exit points before placing a trade can help reduce emotional reactions. Another challenge traders face is managing losses effectively. No one likes losing money, but losses are part of trading. One way to improve is by setting stop-loss orders to limit potential losses. It is also important to accept that not every trade will be a winner. Instead of focusing on individual trades, look at the bigger picture. The goal is to be consistently profitable over time, not necessarily to win every single trade. Traders may also struggle with identifying too many patterns on their charts, leading to confusion and analysis paralysis. To address this, focus on a few key patterns that align with your strategy and ignore the rest. Mastering a handful of reliable patterns is often more effective than trying to learn every pattern out there. Another issue is failing to adapt to changing market conditions. Markets are dynamic, and what worked yesterday may not work tomorrow. It is crucial to be flexible and willing to adjust your strategy as conditions change. Reviewing your trades and analyzing what went well or poorly can provide valuable insights for future adjustments. Lastly, a common problem is a lack of patience. Many traders want quick results, but successful trading requires time and discipline. To improve in this area, consider using a trading journal to track your progress and to stay accountable. Writing down your trades, the reasons for taking them, and the outcome can help you learn more about your trading habits and where improvements can be made. The key is to keep practicing, recognize these patterns when they appear, and always confirm with volume or other indicators before acting. By understanding the challenges you might face and taking steps to address them, you can become a more disciplined and effective trader. Trading is a journey, and every step you take towards improving your skills brings you closer to your goals. The more you practice recognizing chart patterns, the better you will get at finding the ones that work best for you. Practice is key, but it is equally important to practice in a safe environment. One of the best ways to do this is by using a demo or simulated trading account. These accounts allow you to trade with virtual money in real market conditions without any risk to your capital. Most trading platforms offer these demo accounts for free, and they are an excellent way to build your skills and confidence. You can also use backtesting software to test your strategies on historical data. This allows you to see how a particular chart pattern would have played out in past market conditions. Backtesting helps you understand what works and what does not before applying those lessons to live trades. Another great way to practice safely is by joining trading communities or study groups where you can discuss ideas, share insights, and learn from more experienced traders. Engaging with a community can provide valuable feedback and help you stay motivated. Keep at it, stay patient, and soon you will know exactly which chart patterns suit your trading style. Thanks for joining me today, and I would love to hear your thoughts or any questions you have. Feel free to share what you think and let us keep learning together. Happy trading, everyone.